A stock exchange, also known as a securities exchange, is a marketplace where stocks, bonds, and other securities are bought and sold. The exchange provides a platform for investors to trade securities with each other, providing liquidity to the market and allowing companies to raise capital by issuing stocks and bonds to the public. In a stock exchange, publicly traded companies list their shares, and investors can buy and sell those shares on the open market. The exchange provides a central location for buyers and sellers to meet and agree on a price for the securities being traded. The stock exchange is regulated by governing bodies, such as the Securities and Exchange Commission, SEC, in the United States, to ensure transparency and fairness in trading. Trading on the stock exchange can occur through traditional floor trading or electronically, with many exchanges now operating entirely online. Trading on a stock exchange can seem daunting for a beginner, but with some basic knowledge and research, it is possible to start trading. Here are the general steps involved in trading on a stock exchange. 1. Open a brokerage account. To trade on a stock exchange, you will need to open a brokerage account with a broker who is a member of the exchange. A brokerage account is a type of investment account that allows you to buy and sell stocks, bonds, and other securities. 2. Fund your account. Once you have opened a brokerage account, you will need to fund it with money. This can be done by transferring money from your bank account to your brokerage account. 3. Choose a stock to trade. Before trading, you need to research the stock you want to buy. Look at the company's financial statements, news articles, and analyst reports to help you make an informed decision. 4. Place an order. Once you have chosen a stock to trade, you will need to place an order to buy or sell the shares. You can do this through your broker's online platform, over the phone, or in person if you have a full-service broker. 5. Monitor your investment. After you have bought a stock, it is important to monitor your investment. Keep track of the stock price and any news that may affect the company's performance. 6. Sell the stock. When you are ready to sell the stock, you can place an order to sell it through your broker's platform. It is important to note that trading on a stock exchange carries risks, and it is important to do your research and understand the risks before investing your money. The stock market can provide income, but it is not a guaranteed or stable source of income. The stock market is subject to fluctuations and volatility, and the value of your investments can rise or fall based on various factors such as economic conditions, company performance, and market sentiment. Some investors, such as retirees or those seeking stable income, may turn to dividend-paying stocks, which provide regular income payments to shareholders. However, the amount of income received from dividend-paying stocks can also fluctuate based on company performance and market conditions. Another option for income-seeking investors is bonds, which provide a fixed income payment over a set period of time. However, even bonds can carry risks, such as default risk and interest rate risk. It is important to note that investing in the stock market involves risk, and there is no guarantee of returns or income. It is important to do your research, diversify your portfolio, and consult with a financial advisor to determine the appropriate investment strategy for your individual circumstances and risk tolerance. Investing in the stock market carries risk, and it is important to understand these risks before investing your money. Here are some of the key risks to consider when investing in the stock market. 1. Market risk. The value of your investments can rise or fall based on the overall performance of the stock market. Market risk is influenced by factors such as economic conditions, political events, and global trends. 2. Company risk. The performance of individual companies can also affect the value of your investments. Company risk is influenced by factors such as management decisions, financial performance, and competition. 3. Volatility risk. The stock market can be volatile, and prices can fluctuate rapidly and unpredictably. Volatility risk can affect the value of your investments and your ability to sell them at a desired price. 4. Liquidity risk. Some stocks may be more difficult to sell than others, especially during times of market turmoil. This can lead to liquidity risk, where you may not be able to sell your investments when you want or need to. 5. Inflation risk. Inflation can erode the purchasing power of your investments over time, reducing their real value. 6. Currency risk. If you invest in companies or assets denominated in foreign currencies, changes in exchange rates can affect the value of your investments. It is important to do your research, diversify your portfolio, and consult with a financial advisor to determine the appropriate investment strategy for your individual circumstances and risk tolerance. It is also important to remember that past performance is not necessarily indicative of future results, and that investing always carries a degree of risk. Capital gains on stock market investments are generally taxable, which means that any profit you make from selling stocks or other securities will be subject to tax. The tax rate you pay on your capital gains depends on several factors, including your income level, the length of time you held the investment, and the type of investment you sold. In the United States, for example, capital gains on stocks held for more than 1 year are generally subject to long-term capital gains tax rates, which are lower than short-term capital gains tax rates. Long-term capital gains tax rates in the U.S. currently range from 0% to 20%, depending on your income level. Short-term capital gains, on the other hand, are taxed at the same rate as your ordinary income, which can range from 10% to 37% depending on your income level. It is important to keep accurate records of your investment transactions, including the purchase price and the sale price, as well as any expenses incurred during the investment period. These records can be used to calculate your capital gains and losses, and to ensure that you pay the correct amount of tax on your investments. Tax laws and rates vary by country, so it is important to consult with a tax professional or financial advisor to understand the specific tax implications of your investments in your country or jurisdiction.